If you're a trade and construction business owner and you've ever asked yourself the question, when should I take money out of the business? Then this video is for you, because today I'm going to be breaking down our simple 7-point checklist that you can use as a guide to whether or not you're in a position to pull money out of your business. For those of you who don't know me, my name is Troy Larkham, client advisor at Trade Business Accountants, and we help trade and construction businesses typically turning $1 to $10 million a year to build greater security in their business and dramatically increase their profits and cash. So let's dive in. So the big question here is, when should I pull money out of my business? And it's a great question, but before I can actually answer that question, it's important that we're on the same page here of what I mean by pulling money out of the business, because you need to be super careful here. Just pulling money out of your business without first understanding the implications of pulling that money out can leave you in a very, very dangerous situation, and a situation that we find trade business owners in all the time. And that's treating their company accounts as an open ATM for personal use, coming from the idea that it's my business, so I should be able to pay myself whatever I want, right? Not necessarily. Typically, business owners in this situation confuse the relationship between the money sitting in their business and their personal income. They think their business is just an extension of themselves and their own personal income. And this has some truth to it if you're a sole trader, where legally you and your business are considered one legal entity, which is likely the case for most smaller trade operations that have less than 1 or 2 employees. But as soon as your business becomes a registered company, that's a proprietary limited company, the government and the ATO no longer view your business as a single entity. They see you as 2 very distinct legal entities. So the money sitting within your bank account is actually no longer your money. It's the company's money. And even as the business owner, you can't just use the company's money for personal use. Again, it's not your money. So freely withdrawing that money from your company for personal use can actually have damaging consequences if you're not careful. Now, a quick disclaimer here, I'm not saying you can't take money out of your business. I'm just saying you need to do it legally if you want to keep yourself out of hot water. Now, there's only really 4 ways that you can actually legally access company funds for personal use as the owner of your company. And they are: 1, through a salary, a wage, or director's fees, where you're running yourself through payroll. 2, through a reimbursement, where you take back the money you initially invested in the business to get it up and running. 3, through a Division 7A loan from your company, where you're required to pay it back with interest. And 4, through a dividend, where your company issues you a payment from its profits. That's it. They're the 4 ways that you can access company money for personal use. So when someone asks me, when should they pull money out of their business? In most cases, what they're actually trying to ask me is, when should I pay myself a dividend? And it's an important question to know the answer to, because paying yourself a dividend not only has an impact on the health of your business, but it also has an impact on your own personal finances too. If you pull too much money out of your business too early, you can seriously erode the cash cushion that's protecting your business from the tough times. But on the flip side, if you keep too much money in the business for too long, you can risk losing it all if the worst was to happen, not to mention the fact that those cash reserves could have been better invested elsewhere, outside of the business, to build your own personal wealth. That's why it's critical that you have a strategy in place to know when is the right time to pay yourself a dividend. So what I want to do now is run through our simple 7-point checklist that you can use to help guide you in making the call on whether or not to pay yourself a dividend on top of your salary. Now, full disclaimer, obviously we don't know your particular situation or how your current accountant has set up your finances. So make sure you speak with them first before implementing anything that I'm about to discuss. On top of that, if you aren't happy with your current accountant or how they've got everything structured, then make sure you reach out, because we'd love to help you run a better business that makes you far more money. All right. So as a business owner, paying yourself dividends is pretty important. It ensures that you're getting a reward on top of your salary for taking on the risk of running your business. And it's actually a large reason why so many of us went into business ownership in the first place. We wanted to make more money than what a job could ever provide. But the reality is, paying yourself dividends actually isn't the priority. Sure, they're important, but from our perspective, when it comes to bettering your business and your personal life, it ranks at the bottom of the list. So what I want to go through now is the boxes that you need to tick before you pay yourself dividends. If you tick all of these boxes in order, then you should be able to pull out whatever's left over. So what are these boxes that you need to tick? Well, the first box you need to tick is the profitable box. If you aren't profitable, you shouldn't be paying yourself a dividend. And this is largely for 2 reasons. 1, dividends should be your reward for running a business that makes a return in profit. So if you can't turn a profit, then you shouldn't be rewarded. You've got work to do to make sure you start to make a profit in the future. And then two, your business likely can't afford to pay you a dividend if you're unprofitable. And that's because if you haven't made a profit, then you have no extra cash in your business to actually fund that dividend, meaning you're taking cash from the business at a time when your business actually needs the cash the most. And that's because profit is the only source of internal funding that exists in your business. And what I mean by that is if, for example, you're only breaking even and haven't made any profit from last year to this year, then there's no extra money left over. How could there be? Your business made the same amount of money over the past 12 months as what it spent over the same period. So if you're in this position and you pay yourself a dividend, then your business bank account is only going to shrink. And eventually, if you keep doing this, your business is going to run out of money, or you're going to have to fund the shortfall through credit cards and bank loans, which becomes a very, very slippery slope to go down, and it's only delaying the inevitable. Now, the only exception to point number two is if you've been consistently profitable in the past and actually have plenty of cash in the bank account from retained earnings over those years. In that case, you could be in a position to pay yourself dividends, assuming you tick all the boxes that I'll be outlining throughout the remainder of this training. But as a general rule, if you aren't profitable, don't rip money out of the business. Really, really critical. Now, the profit I'm talking about here is operating profit. This is simply the profit that is left over after every single cost in your business has been accounted for. That includes your direct job costs like your labor, your materials, subcontractors, equipment hire, and so on, as well as your overhead costs like rent, accounting, subscriptions, insurance, IT, and other stuff like that. What's left over is your operating profit. Now, on your profit and loss, this is where you would find your operating profit sitting. Now, your accountant might not have your profit and loss structured like this, and your operating profit might actually be called net profit on your P&L. But to make it simple, whatever way it's been structured, operating profit is simply the profit before interest and tax. So that's what you need to be looking for. That's the figure that we're focusing on here. But to wrap up this first item on the checklist, the first rule is if you aren't making any operating profit, then in my opinion, you probably shouldn't be paying yourself a dividend. It's that simple. All right, so that's the first checkbox. Let's move to item 2 on the list, and that's paying your company tax. If you run a profitable business, you're paying company tax. And as simple as this sounds, this is where many go wrong and where many begin their relationship with the ATO debt department. We'd all love to flip taxes to the bottom of the list. I get it, because we want the profit in our business that we make to be ours. But the reality is, in the real world, it's not. Even if you aren't profitable, you're still paying tax, whether that's goods and services tax, capital gains tax, payroll tax. Tax is just part of business. But in this case, though, I'm talking purely about company tax, because again, if your company's profitable, you need to pay company tax. That's why you need to prioritize putting a portion of your profits aside to pay for your company tax. This ensures that you don't spend the money that isn't yours and that you don't end up on the ATO debt treadmill. The key here is to get that profit out of your financial equation. Get it out of your calculations, because it isn't yours to spend. It's the government's. You're playing with the government's money and they make the rules. So make sure you set aside that profit from the start so you can comfortably pay your company tax. Now, some of you might be thinking, well, if I spend my profits, then I won't have to pay any company tax. And you're right, you won't. But you also won't be able to pay yourself a dividend anymore because you're unprofitable now. You've spent the profits and now your business can't afford to pay you a dividend that you could have used to build your own personal wealth outside of the business. I'm not saying that spending your profits is a bad thing. Sometimes it is the right thing to do to help grow the business to give you a greater return down the line. But what I am saying is if you're spending these profits purely just to reduce your tax bill, then you're focusing on the wrong side of the equation. Not to mention the fact that you're spending $1 to save 25 cents in company tax. I don't know about you, but if, for example, I made $400,000 in operating profit, I'd much rather spend $100,000 in company tax to make $300,000 in retained earnings that could have been used to build greater wealth elsewhere outside of the business versus spending $400,000 in profit to save $100,000 in company tax and have nothing left over to build personal wealth with because I've eroded 100% of my retained earnings. This is a flawed tax strategy that we see all the time, so make sure you steer clear of it. The problem with it is you're prioritizing tax reduction over wealth creation. Again, you're focusing on the wrong side of the equation. Now, that's a whole other can of worms that I can save for another video. For now, just make sure you're setting aside enough profit to comfortably pay your company tax on the operating profit that you've made. That's the key here. All right, so once you've set aside the cash to pay your company tax, you can then move to item 3 on the checklist, and that is repaying bad debt. Now, bad is the key word here. Debt in general isn't bad. In fact, it can be a really powerful tool that you can use to protect your cash flow and your existing cash cushion. For example, fixed term debts for vehicles, equipment, or buildings can be really, really important because most of the time you don't want to fund those kinds of investments upfront in cash. It's going to be detrimental to your cash flow. That's why the debt I'm talking about here is mostly debt associated with credit cards and lines of credit, because those kinds of debt can be bad if you aren't keeping tabs on them, because you can start to rack up interest on them really, really quickly. And these interest repayments can be detrimental to cash flow and your ability to build your personal wealth outside of the business, because large chunks of your operating profit are having to be used to pay back this interest. That's why you want to pay off any aged credit card debt or line of credit debt, as well as keep on top of it moving forward, because a true line of credit is one that goes to zero. If you're not going to zero, banks will look at you and know you're just one bad business cycle away from needing to make an arrangement to pay off that debt. Now, if you can't pay it back because your business doesn't make enough cash, then you've likely got bigger problems that need to be resolved as soon as possible. If this is the case for you, I strongly recommend that you go and watch our cash flow masterclass training that we've provided for free on our channel, because in that training, we provide a super simple framework that you can use to flood your business with more cash, which is going to be something super helpful in getting your credit lines under control first before you start to even think about paying yourself a dividend. Your business should be able to fund itself. Don't fall into the trap of falling deeper and deeper into debt to fund a business model that just isn't working. You're leading yourself into a really, really dangerous situation. Again, debt can be a great tool in business, don't get me wrong, but if you're using debt to mask the issue of an unprofitable business, that's where you'll run into trouble, because in those circumstances, I can almost guarantee that throwing more money at your business won't get you better results. It will just dig the hole deeper and deeper and only delay the inevitable. So again, if this is your situation, make sure you go and watch this masterclass training. All right, so once you've paid off all your bad debt, you can then move to item 4 on the list, and that is building your emergency cash cushion. This is simply the minimum amount of cash that you need to fund your business's operations in the short term if things were to go wrong, because you never know what's around the corner. You should always try to find ways to limit the troughs in business, but in most instances, there's usually nothing you can really do to prevent them. So what matters is how you prepare. That's why you want an emergency cash cushion. It's your safety net. It's your protection and buffer against the financial hits that are destined to happen in business. It allows you to weather yourself against the storms, and it gives you some cash reserves that you can use to invest in critical business assets that allow you to continue delivering the work that you do during these tough times. You should be able to fund these shortfalls with your own internal cash for quite some time without a line of credit or without using credit cards. If you have to immediately jump to these other sources and go into debt when things get tough, then you're likely in a really dangerous position where your business could spiral into a really bad debt situation really quickly, which is why you want the cash there. So the question is, though, how much should you have in your emergency cash cushion? Well, how much cash do you need to support your business should sales take a dive, or a client delay their payments, or you unexpectedly get struck by an illness? There's a range of different things that can go wrong in business that you need cash to cover. But from my experience, the worst downstrokes from these kinds of events seems to be roughly 2 to 3 months of overhead costs. This is why a good rule of thumb is to have enough cash reserves on hand and nothing drawn on a line of credit to cover your overhead costs and salaries for at least 2 months. That means you can cover all the costs in your business that'll keep eating away at your bank account, even when you don't sell anything, like salaries, rent, subscriptions, vehicle repayments, and other costs like that. You want to be able to cover them for a whole 2 months. So for example, if your overhead cost and salaries averaged around $150,000 per month, then you should really be aiming to have $300,000 in the bank account at a bare minimum. That's 2 months of costs covered, even if you weren't to sell anything. Now, a business with $150K in operational costs per month is probably turning over $3 million a year in revenue. Now, at a 15% operating profit margin, this business could probably bank that in 2 years. So start building this cash cushion today and don't pay yourself a dividend until you do. And once you have your 2-month cash cushion, don't touch it. It's purely there for tough times only. Look at it as if it's your new 0 point in your bank account. This will ensure that you never have to stress about not having enough cash to run the business during a downturn, something that happens far too often in our industry. All right, so now that you've built your emergency cash cushion, you can then move to item number 5 on the list, and that is to build your growth capital. Growth capital is simply the cash on top of your emergency cash cushion that you need to use to fund growth, whether that's to cover a new hire that needs time to be brought up to speed, investing in equipment needed to grow, or funding the natural increases in money owed to you by customers when you start to grow. These are all elements of growth that need to be funded with cash. Now, this is optional because if you don't want to grow anymore, then you don't need growth capital and you can just jump straight into the next item on the list. However, if you do want to grow, ticking this box is critical. Sure, you've got a cash cushion there, but that's purely for emergency situations. Funding for growth should not come from your emergency cash cushion. It should come from capital growth. So the question is, though, how much should you have in growth capital? Well, this one's a bit of a harder one to answer because it really does depend on the rate that you'd like to grow at, because the faster you grow, the faster you're going to need cash. So I'd really have to sit with you one-on-one to break down what this would need to look like for you personally. But as a rough guide, you should be at least aiming for an extra month or two in cash on top of your emergency cash cushion. This means all up, you should have enough cash to fund your current operations for at least 3 to 4 months. So thinking about the same example from earlier, you need at least an extra $150,000 in growth capital on top of your cash cushion, which is $450,000 all up. Now, I'm not saying you can't grow until you save that extra month's worth of cost. It's just important that you're aware that while you're growing, you should be continually focused on banking the profits left over to ensure you stay in the clear with your cash as you grow. But again, it really is dependent on how fast you grow, because if you want to double your business over the next 12 months, then you'd need a minimum of at least 2 to 3 months of growth capital on top of your cash cushion at a minimum. So that's, 4 to 5 months sitting there in cash to be able to fund that growth if you were looking for that rapid growth. So again, just use this as a rough guide. For most of you though, an extra month in reserves on top of your emergency cash cushion should be more than enough to fund your own growth comfortably. And the reason why I stress this is because just as many businesses go under from overtrading as they do undertrading. It doesn't take much to cripple a business that's overextended without enough cash to fund itself should something happen, like delayed payments or promised contracts falling through or accidents on site and all those kinds of incidents that are largely outside of your control. All right, so at this point, you're profitable, you've set aside your tax, you've repaid bad debt, you've built your emergency cash cushion, you've built your growth capital if you're looking to grow, and then let's say you have $100,000 left over in retained earnings. Well, before you look to take this $100,000 out, there's one final question you should be asking yourself. And that is there something I can spend this $100,000 on for the business that will get me more than $100,000 back? Now, like I said earlier in the training, don't even consider spending that $100,000 just to save 25 cents on the dollar in taxes. That probably isn't a smart move. Focus on what's going to make you more money. Look to invest to get better returns. And if the answer is no to this question, then is there something you should be building towards that costs more than $100,000? Maybe you want to buy a competitor, spin off a new business, or purchase a big piece of equipment that would really change the markets you can get into, or invest some of that $100,000 into necessary gear or staff or tech to drive better efficiencies. Whatever it is, you can keep saving until you hit the number that will help you reach a big goal. Always be looking for opportunity on the horizon. And at the same time, make sure you're banking cash. Opportunity loves cash. If there isn't a goal, then this is the time to pay yourself dividends. Now, when it comes to paying yourself a dividend, there's no set amount or percentage that you should be taking out. It really just depends on the circumstances. If you've built yourself to a point where you've ticked all those boxes, then you're likely in a position to pay yourself 100% of those after-tax retained profits. But if you're wanting to continually grow, or even depending on how big your receivables are, how much inventory you have to fund, or how many assets you have to buy, you might be building capital forever. So you can only take a much smaller portion of the profit, or in some cases, none at all, because the business needs those retained earnings to be able to fund that ongoing growth. But either way, if you're planning to pay yourself a dividend, as a golden rule, take dividends on a structured basis at planned times throughout the year. If you're having to take dividends frequently at random times throughout the year, it likely means you're not paying yourself a fair market salary. So what you're earning month to month from your wage isn't actually enough to fund your lifestyle. So you want to really get this under control so you can start taking dividends formally and ideally living off your wage and using those dividends to invest and start building your own personal wealth outside of the business. Too often we see business owners try to live off the dividends of their business, and then there's nothing left over for wealth creation. But at TBA, we strongly recommend that you try to live off your salary and use the dividends to build your own personal wealth. Now, some of you might be disheartened to hear all of this because it sounds like you'll never be able to pay yourself dividends with all this other stuff you have to pay for and fund first with your retained earnings. And while yes, there's some work that needs to be done before you can reap the rewards of your business, the key here is to reset your mindset and have a longer term perspective. Sure, you could pull more money out earlier for yourself, but what's the longer term impact of that? The reality is you can build far greater wealth with a little bit of delayed gratification. For example, let's say you're running $1 million business at a 15% operating profit margin. So after tax and interest, you might have $100,000 in retained after-tax profits that you can pull out on top of your salary. So that's pretty good, right? But what if you sacrifice that income and chose to reinvest it back into the business to grow it to $5 million in revenue over the next 3 to 5 years? Sure, you might have missed out on that $300,000 to $500,000 of potential personal income over those years, but with a $5 million business at a 15% operating profit margin, you'd be probably making roughly around $500,000 in after-tax profits every single year. That means in a single year, this $5 million turnover business can pay you the same amount of dividends as what it would take the $1 million turnover business to pay you over 5. That's a huge difference. And at that point, you can either choose to grow beyond the 5 million and make an even better return, or maintain the business at that size and pull out $500,000 for yourself every single year. So rather than paying yourself $100,000 in recurring dividend payments, now you're paying yourself $500,000 year on year in dividends with just 3 to 5 years of delayed gratification. You've pretty much 5x'd your ability to build your wealth forevermore moving forward. Even if you took that original $100,000 dividend payment from the $1 million business and reinvested it elsewhere, whether that's property or shares, there's a very, very strong chance you would not get the same return on investment. They average what, a 5 to 10% return on investment year on year? A business that is set up right and performing well can easily achieve a return of 50 to 100% year on year. In fact, that example I just went through is a business easily making more than a 75% return. Yes, it takes time, but if you build the foundations of your business correctly from the start, then you too can build a business that gives you returns like this. And once you have a rock solid business that has become a cash producing machine, you've ticked all the boxes and you're free to take money out on a structured basis, then you can look to other areas such as real estate or shares and so on, where you can dump your money in assets that are going to continue to make you more money and really de-risking your wealth and personal income because you're diversifying where your income is coming from, which really is the key in building greater security for your life and income moving forward. Now, if you want help to make this kind of business a reality, then make sure you reach out because we'd love to help. All right, so that's our 7-point checklist that you can use to determine whether or not you're in a position to pull money out of your business. So those points are: 1, are you profitable? You've got to be profitable if you want to be pulling money out. 2, have you set aside a portion of those profits to pay for your company tax? Again, you don't want to leave that till the end and end up on the debt treadmill with the ATO. They're not exactly my lender of choice. Number 3, have you paid back bad debts? Again, not every single debt. We're not talking about fixed term debts to buy vehicles and finance vehicles and stuff like that. I'm talking about debt associated with credit cards and lines of credit that continues to stack and build, which is just going to have a huge interest payment on it year on year, destroying your cash flow and eroding your returns. 4, have you built your emergency cash cushion to fund those tough times? Those storms that are bound to happen. You need the cash there to be able to support your business for at least 2 months. That's salaries and operating costs. Really, really critical. Number 5, have you built your growth capital? If you're looking to grow, it's critical that you have further cash cushion there on top of your emergency cash cushion to be able to fund that growth without having to go into debt. Of course, I'm not saying you shouldn't do that. If you can do it strategically, it can be an effective strategy to do. But if you can focus on funding that through your own cash reserves, that's really, really beneficial. Number 6, can the retained earnings be reinvested somewhere in the business to make sure that what's left over can give you a better return long-term? Again, that long-term perspective is what we're looking for here. So again, make sure you ask yourself that question. Once you tick all those 6 points, the final point, number 7, is to finally pay yourself dividends. Again, there's a process before you can start to pay yourself dividends. You don't want to just be pulling money out randomly. You need to make sure it's calculated and it's a sensible decision for the health of your business. You've got to prioritize the health of your business and have that longer term focus to make sure that what you're creating there is a valuable asset that can give you returns forevermore year on year beyond what you'd be making if you just had that short-sighted, short-term viewpoint of pulling those dividends out too early. So again, follow this 7-point checklist. In my experience, I think more trade business owners need to follow this order because typically many actually go the other way around where they spend their profits first and then find themselves in hot water with the ATO or debtors, ending up on that treadmill of debt. And they don't focus on getting their business to the right profitability that it should be at. Not to mention the fact that they rarely end up having enough cash in the business needed to operate with that emergency buffer. In fact, I've seen plenty of contractors who often have $0 cash in their business. Payment comes in, payment goes out, but there's often nothing else sitting there at the end of the day. This is a position that you just do not want to be in moving forward. So if you follow this 7-point checklist that I've outlined today, you'll put yourself at far better odds of building a secure business that gives you strong returns, allowing you to build your own personal wealth beyond just the business year after year after year. So with that being said, keep getting after it. If you have any feedback or questions, let me know in the comments below. Like and subscribe if you haven't already, and I'll see you in the next video.